Kia ora, it's Joe. We're going to go through the Londsdale limited exercise now, which covers the share repurchase from a company buying back some shares, right? So we'll look at how that's accounted for, how that affects the capital section of the statement of financial position, and we'll also sort of consider why would you do that, all right? Okay, so here's the example we've got. There's 450,000 ordinary shares fully paid, okay, and that's the value of those shares, all right. We'll be using that information to work out what the weighted average value of those shares are, okay. So that's over here. So maybe let's consider that. Okay, so it's quite a simple calculation. It's how many shares, what's their value, how much are they worth each, all right. So I've done that calculation. Let's have a look at it. So the value is 787,500. That's the number of shares there are. Okay. So therefore that's what they're worth each. All right. Over here we'll look at how many are repurchased later. Okay. Okay. So that's the information we're looking for here. That's what they're worth each. All right. Okay, let's move along. There's some preference shares, and there are some asset revaluation reserves, so assets have improved in value over time. It doesn't state whether that's realised or unrealised. And there's retained earnings. Okay, so that's how much profit's been retained over the previous years. All right. Okay, so basically the total equity of this company is 1,662 or 1,662 $500, so 1.6 mil basically. Okay, so on the 1st of July, the directors meet and resolve to make an offer to all of the ordinary shareholders to buy back 15% of the issued share at a price of $1.95. Okay, so they're actually offering more than what they're listed in the book as. Okay, the ordinary shareholders had until the 31st of July to accept the offer. The shares will be cancelled upon repurchase, so when they buy them back, it's going to reduce the number of shares, right? On the 31st of July, 60% of the ordinary shareholders had accepted the offer. Okay, so let's have a look at what's actually happened with that acceptance there. Okay. So ordinary shares accepted 60%, so we're going to buy back 15% of the, 15% of those. Okay, so there was 450,000 shares. Of those, 60% of those shareholdings have agreed to sell back 15%, so 15% of 270 gives us that. Okay, all right. We know what the value of those is. We're going to give them $1.95. Actually, there's the value of them. We're actually going to give them $1.95. We're going to give them 20 cents more, and we need to work out where that 20 cents is going to come from, right? Okay. So therefore, we're going to pay back that. So there's a difference between what they're worth in the books and what we're paying for them. Okay. Right. So we need to do a journal entry. Okay, we need to reduce down the ordinary shareholdings by what they're worth in the books. Okay, all right. So that equals that. We need to recognise how much we're paying out of the bank, which is that amount there. And the difference being is where we're going to get that extra money from. We're going to get it from retained earnings. All right. So retained earnings will be reduced by the difference between the two. So that's the journal entry for buying back shares. All right. How would that buyback affect the capital section of the statement of financial position? Basically, we just need to add this journal entry. Okay. So we know that it hasn't affected the preference shares. There's nothing getting accounted to there, so that'll remain the same. Okay, we know that we've done nothing to the asset revaluation reserve, so that'll stay the same. Okay, What we do know is that we've posted, we've reduced the paid up fully ordinary shares by 70,875, so it'll be that figure less that when we post it, which will give us the new figure there. Okay, we know we've put a journal to reduce retained earnings. Okay, so that's the 200 less that. Okay, the bank account we're not showing in the section. That would have reduced obviously down by that in the balance sheet, and therefore we've got a new total equity of that figure there, 1.5. Okay, a little bit more. $1,583,525. All right, so that's the journal entry. The journal entry posted. The next section is why would a company repurchase its own shares? Okay, you can do a little bit of research about this. Okay, all right. There's an articles on it. Some of the points are here. Okay, right. To use up funds it has accumulated and probably nowhere else to invest them. To reduce the number of shares it has on issue and then reduce total dividends in the future. To prevent a takeover of the business, the company may think its shares are undervalued. So if its shares are undervalued, it'll think, well, why not buy some of our own shares back because we believe they're worth more. Okay, and here's a link there as well. But do your own research into why a company may repurchase its own shares. Right, I recommend researching a few things. It's not only that, obviously. Some of the other sort of things we've looked at, like share splits and those sort of things. Do your homework on why a company might be doing that. Right, so that's the Londsdale exercise.